All right, let's talk the difference between strat and ICT, or the box setup, or however, whatever, smart money concepts, whatever you want to call it. So ICT will tell you that this is a liquidity purge, right? Once you come back into this, you've purged external liquidity. You're going to target internal liquidity, potentially the other side of that external liquidity, which if we're targeting other side, it'd be down here. And then it happens, right? So if we're doing the box setup, all you do is you add one extra line right here. You'd say, here's the big box. You can see it gets stuck inside of all that, goes up, back through the box, expands, pokes way below this low. So we look for the lower high. Here's your box setup right there, and then puke. And that works. That's fine. If you're trading futures, do it all you want. If you're good at it, good for you. ICT and strat differ here. We will call this a level of reclaim, because instead of using all these fancy words, that's just a level of reclaim. Reclaim the level, you're going back to the other side of the range. That's the whole concept. It's the same thing as a broadening formation. It's just not accounting for time. And what I mean by that is broadening formation lines account for time. So when the range starts really small like this, you can see your try looks like that. Notice how it gets bigger over time, right? So that tells us over time this range will get bigger. If you're just drawing horizontal lines, does not account for that. So the way we would draw this as time goes on is this. These two bars here go outside of this. This is where the range starts. Pokes down, 322 long. Where's it going? Up there. And we'd redraw. Goes like that. Makes the new high to this high after making the new low to this low. So we can redraw again. Goes like this. And then it comes back in. They did inside and up, so we could have tried to the high again. You can see just shy of it hitting the first target. Comes back in. Where is it going to try and go? Back to the other side of these guys. And this range is still small. This is not what we're looking to trade. So they do that. Now the range is slightly bigger. Still very small range, not something we're looking to trade. You see the range is bigger. 3, 2 down, comes back into the 3, they make it up there. Slight highs to this. Inside bar, breaks down, pivot machine gun, wipes them all out at the end of the day. Now the range is even bigger. Like so. So now, when we come up in here, in pre-market, if we're trading futures, this tells us the shooter 60 at the top of the try makes it more likely we're going to top the bottom of the try. And we know that when that forms. So you might have your little, you'd call it a box setup, or maybe you call it your entry model, whatever it is in here. You see here's your little entry model. You can see purges the highs, comes back in, slight lower high to get short with the stop here, and then they puke. So you get maybe 5 contracts short, partial when it hits the, I don't know if we can do this here. So let's say the 50% is like here, maybe partial at 50%, maybe partial at the 50% of this wick here, and then maybe partial again or fully exit at the new low here. As far as we're concerned, when this 60 works and then we see this puke, that's confirmation of what? The fact that we're going down there. So once that works, unless this 60 gets reversed, we look to add. And we would make one contract short because the first entry is the riskiest because you have no money in play. Now, once you have a winning position, you can add to it because now you have their money. So maybe you have one short, and then you add 2, and then those adds start working, and you start adding 3 more. Maybe you have 7 contracts short, maybe add another 3. The redder this gets, the more likely it is to take this out and that broad bottom of the try. So that's the big difference. As far as futures are concerned, since they chop so much, it's a lot harder to do that because they're going down and then up and then down. And then they do recover a little bit and then down again, and then fully back up and then down again and then fully back up and then keeps going. So you can do it. You're just going to have to be more diligent in the fact that you're going to stop out. You're going to have positions that go from big profit, maybe come back a little more than you'd like before you stop out, things like that. But what we do is we don't trade the futures because you get just the average of 500 stocks at the ES. And then the NASDAQ, just the average of 100 stocks in the NASDAQ. And then the Dow Jones, you get the average of, I believe, 30 stocks if it tracks the DIA. And then with the Russell, the RTY, the average of 2,000 stocks. So when you're looking at the Russell and they're making these gigantic moves, Imagine how big the moves are on the stock that's actually doing that within the 2000 stock index where everything's weighted like less than a percent. That's what we go and look to trade. Although we do trade, if we go, we do trade things like IWM because we get pretty nice moves, makes it a little easier than sorting through 2000 stocks. What we want to do is we want to break it down by sector. And this is where the secret is with the strat. If you can do this, you have a great time. So if we break it down by sector, you can see this. These are all the different sectors. We have gold, transports, communications, telecom, ETF, jets, which is the airlines. We have regional banks. We have China stocks. We have silver. We have chips, biotechs, home builders, materials, communications, energies, financials, industrials, consumer staples, real estates, utilities, healthcare, retail, which I might have said twice. Nope, XRT retail. And there's more than just this. There's even more. I don't go through every single one. I can't. It's too much work. So since we can do that, instead of trading the SPY or the futures as you guys would do, where you can see if we go on the SPY, the month is pretty green at this point, but that didn't happen until recently. You can see from the 1st of the month to the 15th, they're relatively flat. Just hits the month open, bounce, month open, bounce, month open, bounce. And then finally, you have a big enough range, slight lower low. The other side of your range is that. So you get a nice range to trade through. But what was happening while that's happening? XLE Energy ETF, the first day of the month here, within 4 days, that's now green on the month, and it has not reversed. 2221 inside bar add is what we call that. And then 2 Momo Hammer, 222. Here's your reversal, but still good on all the other time frames. The week, nowhere near reversing that. The month, bright green still happening. So what we do is we add on this. We talked about this last Tuesday. And then you get 2222 because they're still buying energies. So we go and buy the strongest ones. And we also get a lot more information. It's not just XLE, it's also XOP, which is oil and gas exploration ETF, which is a different subsector in the energies. And then we also get OIH, which is the oil services ETF, which is another subsector in the XLE. So we have so much more information as to what's happening. And then even from there, we can go into the strongest things in the OIH or XLE or XOP. So like MPC. Look at that. You can see just this month, compare that to the SPY, 170 to 200, 17%. And look at the daily. From the 1st of the month, you had one lower low here, and that was it. Slight lower low, and then boom. Compare that to like SPY or the futures that you guys are trading. Slight lower low here, and then they do kind of take off, but now they're done. Even in here, it's like, okay, you did take these guys out here. They did take off a bit, but this is misleading because this is the contract change event. If we look at the 3-11 on SPY, very different. So it's like takes them out and then kind of, and takes them out a little bit, kind of, takes them out a little bit, and then finally. It's just a completely different way of trading. So hopefully you guys can see why we do this the way we do. You get a lot more things to look at. Some people don't like that. And if you don't, that's fine. Strat's not for everyone, but it should be because you'll have a lot more time, or a lot more fun trading things that are moving. You'll be able to trade the things like Dollar General where in one day you can see, boom, 166 to 150, $16 in a day. And that happened within the first 2 hours of the day. If you go in here. Look at this. The first hour, boom, the whole daily range in 1 hour. And you can see our try. Do we know that's how big the range is because we can gauge time with our lines? Yeah. So hopefully this answers a lot of questions, gives you guys something to think about as far as what you're trading and why. And that's going to be about it for me. So I will see you guys in the next video. Hope you guys have a great rest of your night.